In February 2021, Cathie Wood's ARK Innovation ETF was worth $28 billion. By December 2022, it had lost over $40 billion in value. Here's what makes this collapse fascinating. Wood had access to the same warnings, the same data, the same market signals as everyone else. She just couldn't see them, not because she was stupid, not because she lacked experience, but because her brain was doing exactly what human brains evolved to do, protecting her from information that contradicted what she already believed. Right now, your brain is lying to you, not maliciously, protectively. Every second, your sensory systems process about 11 million bits of information. Your conscious mind can handle about 4 sality. That means your brain is constantly deciding what gets through and what gets filtered out. And here's the uncomfortable truth. It's not choosing randomly. Your brain prioritizes information that confirms what you already believe and downplays information that challenges it. Psychologists call this confirmation bias, and it's one of the most stubborn cognitive distortions we possess. Let's make this concrete. Imagine you just bought a new car, a Tesla, let's say. You spent $50,000. Within 24 hours, you'll notice something strange. Suddenly, you see Teslas everywhere. They were always there. Your brain just wasn't flagging them as important. But now you've made a commitment. You've invested money and identity into this decision. So your pattern recognition system starts serving you evidence that you made the right choice. You notice the acceleration, the smooth ride, other Tesla owners who seem happy. What you don't notice, or what you rationalize away, are the panel gaps, the service complaints, the recall notices, that article about battery degradation. Your brain treats contradictory information like a threat to your self-concept, so it simply doesn't assign it the same weights. The psychologist Peter Wasson first documented this in 1960 with his famous card experiment. People would cling to their initial hypothesis even when presented with falsifying evidence. They'd seek out confirming cards and ignore disconfirming ones. Watson thought people would update their beliefs when shown clear contradictions. They didn't. They got more creative with their justifications instead. This isn't stupidity. It's efficiency. In our ancestral environment, constantly second-guessing your decisions about which berries were poisonous or which path led home could get you killed. Confidence, even overconfidence, had survival value. But in the modern world of investing, where being precisely wrong costs more than being approximately right, confirmation bias becomes expensive. Very expensive. Catherine Wood started her career in 1977 at Capital Group. By 2014, after stints at Jennison Associates and AllianceBernstein, she'd spent nearly 4 decades in traditional asset management. Then, at age 57, she did something radical. She left to start ARK Invest with a laser focus on disruptive innovation. Her thesis was compelling. Traditional investors were systematically undervaluing exponential technologies because they used linear models. She believed in artificial intelligence, robotics, genomics, blockchain, and electric vehicles with religious conviction. For years, the market ignored her. ARK's flagship fund, ARKK, launched in 2014 with modest interest. By 2019, it had about $1.9 billion in assets. Respectable, but not revolutionary. Then 2020 happened. The pandemic accelerated every trend Wood had been preaching about. Remote work, telemedicine, digital payments, e-commerce. Suddenly, her portfolio of Zoom, Teladoc, Roku, and Tesla wasn't contrarian anymore. It was prophetic. ARKK returned 153% in 2020. Let me repeat that. 153%. When the S&P 500 returned 18%, money flooded in. By February 2021, ARKK had swelled to $28 billion in assets. Cathie Wood appeared on every financial network, Bloomberg, CNBC podcasts. Her price targets were audacious. Tesla to $3,000 per share, Bitcoin to $500,000. She published her research openly, unusual for the industry, and her confidence was magnetic. Here's what's crucial to understand. Wood wasn't making random guesses. She had models. Her team published detailed research reports with TAM analysis, S-curves, and Wright's law projections. The research looked sophisticated because it was sophisticated, But sophistication and accuracy aren't the same thing. By mid-2021, warning signs were everywhere. Valuations had detached from fundamentals. Zoom was trading at 50 times sales. Teladoc at 25 times sales. Interest rates, which had been near zero, were clearly headed higher. And high multiple growth stocks are mathematically more sensitive to rate changes. Traditional value investors started calling ARKK a bubble. Jeremy Grantham warned of euphoria. Michael Burry, the guy who called the 2008 housing crisis, literally took a short position against ARK. Wood's response? She doubled down. Not just rhetorically, actually doubled down. She bought more. In her view, the critics didn't understand exponential growth. They were trapped in old paradigms. They'd been wrong before, and they'd be wrong again. ARKK peaked at $156.98 on February 12, 2021. Then it started falling, and falling, and falling. By December 2022, it had lost 76% of its value. $40 billion in investor wealth, gone. In 1979, Stanford professor Charles Lord conducted an experiment that perfectly predicts what happened to ARK's investors. He gathered people with strong opinions about capital punishment. Some for it, some against it. Then he gave both groups the same two research studies to read. One suggesting the death penalty deterred crime, one suggesting it didn't. Logic says that when confronted with mixed evidence, people should moderate their views, right? Move toward the middle? The opposite happened. After reading identical information, both groups became more convinced they were right. The pro-death penalty group found the pro-deterrence study more convincing and picked apart the methodology of the other one. The anti-death penalty group did the exact reverse. Same data. Opposite conclusions. Stronger polarization. Lord called this biased assimilation. We don't just seek confirming evidence, we interpret ambiguous evidence as confirming. It's confirmation bias on steroids. This is precisely what happened in the ARK community between 2021 and 2022. As the fund dropped 20%, then 40%, then 60%, investors had two options. Admit the thesis was wrong, or find reasons why the thesis was actually more right than ever. Many chose option 2. On Reddit's r/ARKinvest and Twitter's FinTwits, a fascinating pattern emerged. Every piece of bad news got reframed. Zoom's declining revenue? That's just post-pandemic normalization. The real growth is still coming. Tesla's competition from Ford and GM? Legacy automakers will never catch up. They don't understand software. Rising interest rates? A temporary overreaction. The Fed will have to pivot. Cathie Wood herself modeled this perfectly. In November 2021, with ARKK down 35% from its peak, she didn't reconsider her valuations. She recalibrated her conviction. She published a note explaining that the sell-off created a buying opportunity. Her 5-year price target for Tesla? She raised it from $3,000 to $4,600 per share. Here's the insidious thing about confirmation bias in markets. It has a built-in reinforcement mechanism. When you buy a falling stock, if it bounces even temporarily, your brain floods with dopamine. See? I was right to buy the dip. This neurological reward makes the bias stronger. Neuroscientist Tali Sharot at University College London has shown that our brains literally process confirming information differently than disconfirming information. When we hear good news about something we believe in, we show increased activity in the ventral striatum and rostral anterior cingulate cortex, areas associated with reward and emotion regulation. When we hear bad news, those areas go quiet. We don't integrate it the same way. It's not that we're consciously ignoring contradictions. Our brains are pre-processing the information before it even reaches conscious awareness, tagging some data as important and other data as noise. By the time Wood was consciously considering market feedback, her brain had already filtered it through her conviction that disruptive innovation was inevitable. The academic research was screaming a warning. Wood couldn't hear it. Neither could her most devoted investors. While ARK's investors were losing billions, someone else was making a fortune off confirmation bias. Short sellers. Michael Burry, through his fund Scion Asset Management, publicly disclosed a short position against ARKK in December 2021. His timing was nearly perfect. He understood something crucial. Confirmation bias doesn't just affect true believers. It affects when they finally capitulate. The trade wasn't just betting that ARK's stocks were overvalued. Lots of people knew that. The trade was betting that Wood's conviction, and her investors' confirmation bias, would keep them buying the dip long enough to create a sustained, profitable decline. Every time ARKK dropped and Wood appeared on CNBC explaining why her 5-year thesis was intact, Burry's position grew more valuable. He was essentially shorting human psychology wrapped in an ETF structure. By October 2022, reports suggested Burry's position had gained more than 50%. He wasn't smarter about Tesla's technology or Zoom's competitive moat. He was smarter about cognitive bias. But here's what makes this story more than just a cautionary tale. Some investors beat the bias. Not many, but some. Daniel Ek, CEO of Spotify, and an early ARK investor, reportedly reduced his position substantially in early 2021. Not because he stopped believing in innovation, he recognized valuation risk. His internal model apparently had a tripwire. When forward PE multiples exceeded a certain threshold, regardless of narrative, he'd rebalance. That's the key. He'd predetermined a rule that would override his conviction. Similarly, some institutional investors who'd allocated to ARKK had systematic rebalancing rules. When ARK exceeded 5% of their portfolio due to 2020's gains, they automatically trimmed it back to 3%. They removed discretion from the equation. They didn't try to fight their bias. They designed around it. The research backs this up. In a 2011 study, psychologists at Cornell found that people who made implementation intentions, specific if-then plans, were significantly better at overriding cognitive biases, not because they were less biased, but because they'd created external systems that triggered actions before bias could take over. It's like Ulysses tying himself to the mast before hearing the sirens. He knew he wouldn't be able to resist in the moment, so he removed his future self's ability to choose. The tragedy is that Wood actually had this kind of system in her earlier career. At AllianceBernstein, she worked within a structure with risk committees, position limits, and valuation frameworks that constrained individual conviction. When she founded ARK, she deliberately removed those constraints. She called it intellectual freedom. The market called it risk. There's a deeper irony here. Wood's entire thesis was about seeing what others couldn't see. About having conviction when consensus was against you. That's exactly what confirmation bias feels like from the inside. It feels like courage, like vision, like intellectual independence. The only difference between conviction and delusion is whether you're right. And you don't know which it is until it's too late. So here's the uncomfortable question. If confirmation bias is hardwired, if it operates below conscious awareness, if even sophisticated investors with decades of experience fall victim to it, what chance do you have? Actually, a better one than you think. Because unlike Cathie Wood in 2021, you now know exactly what to look for. First, name your beliefs. Write them down, specifically. Not, I believe in tech, but I believe Tesla will reach a $2 trillion market cap by 2026, because autonomous driving will create a robotaxi network. Precision is your friend, because vague beliefs are impossible to falsify. They morph to fit whatever happens. Once you've named a belief, do something radical. Write down what evidence would prove you wrong before you buy the stock, before you're emotionally invested. Karl Popper, the philosopher of science, called this falsifiability. A belief you can't imagine being wrong about is a religion, not an investment thesis. Cathie Wood believed in disruptive innovation. Fine. But what specific financial metrics would indicate the thesis was failing? User growth? Revenue growth? Profitability timelines? If she'd written those down in advance, the 2021 data would have been unambiguous. She didn't. So every data point became interpretable. Second, build a kitchen cabinet of people who think you're wrong. Not devil's advocates who secretly agree with you. Actual skeptics. Give them permission, even incentives, to challenge you. Ray Dalio built this into Bridgewater's culture with radical transparency and idea meritocracy. Your kitchen cabinet doesn't need to be that formal, but it needs to be real. Here's the test. When they criticize your idea, does your chest tighten? Do you feel defensive? That's your confirmation bias activating. That's the moment you're about to dismiss valid concerns. Third, separate your identity from your investments. This is the hardest one. And you tell everyone at Thanksgiving that you're all in on crypto. You've just tied your self-worth to Bitcoin's price. Now every dollar it drops doesn't just cost you money, it costs you status. Identity. Your brain will fight like hell to protect that. Professional poker players understand this deeply. Annie Duke, in her book Thinking in Bets, describes resulting, judging decisions by outcomes rather than process. A bad decision that worked out feels good. A good decision that failed feels terrible. Your brain remembers the feeling, not the logic, so it learns the wrong lessons. The fix? Keep a decision journal before you invest. Write down your reasoning, your confidence level, and your exit conditions. Then, 6 months later, review it. Not the outcome, the reasoning. Were you considering alternative explanations? Were you seeking disconfirming evidence? Were you overweighting recent data? This practice creates metacognition. You start noticing your own patterns. Fourth, use base rates. Remember when Wood said Tesla would hit $3,000? Then $4? $600? Ask yourself. Historically, how many companies with Tesla's revenue have reached that valuation? What percentage of high-growth tech stocks maintain their multiples as they mature? The answer might not determine your decision, but it should inform your confidence level. Most investors think they're above average, which is statistically impossible. Base rates remind you that you're probably not special. Finally, remember the opening question. In February 2021, Cathie Wood had the same information as Michael Burry. Same market. Same financial statements. Same interest rate projections. The difference wasn't the data. It was which data they allowed themselves to see. Your brain is right now filtering information to protect your existing beliefs. About stocks, about crypto, about real estate, about your career. The question isn't whether you have confirmation bias. You do. Everyone does. The question is whether you're brave enough to build systems that override it. Because here's what the ARC story really teaches us. Conviction feels identical to delusion until reality renders its verdict. And by then, it's your money that's gone. If this video made you question your own beliefs, that's the point. Subscribe for more deep dives into the psychology of money. Next up, how recency bias turned house flippers into bag holders in 2008. You won't see your portfolio the same way again.